In 2025, I started a new portfolio where I add $1,000 per month into a dividend grower, and the goal is to reach $100,000 by the end of 2031. Today, I share with you my 7th position in the portfolio, and I'm going to tell you what I'm going to add in October. Dividend growth investors, bonjour. My name is Mike Hiro. I'm the founder of Dividend Stocks Rock, and I am using all the tools that I've built to grow this portfolio and invest with conviction. All right, so let's get started and see where I am at after adding 7 stocks to my portfolio so far. So as you can see, the portfolio value is almost at $8,000. So I'm at 8% of my goal to reach $100,000 by the end of 2031. The goal by adding $1,000 a month at an annual growth rate of 6.5%, I should be able to reach my goal. Having said that, I added 7 positions already, but I started in February. So where's the catch? Well, I completely forgot to add 1 stock during summertime. I was too busy traveling in Peru, completely forgot about the purchase. So at the end of this year, I will probably make it up and make it another contribution, so to have 12 stocks by the end of this year. So let's get started with my portfolio now to see where I'm at. I have 3 winners in my portfolio at this time. So Franco-Nevada, Stantec, and National Bank. So Franco-Nevada is a play on gold. It's a streamer with no debt. I thought it was a pretty smart move as tariffs are looming, a lot of concern. So investors are buying a little bit more gold. I wanted to surf on that bull trend. Now for Stantec, it's a play on infrastructure, it's an engineering firm, and they show amazing results. They have a strong backlog, so going forward, I am confident that they will continue to report great returns. As for National Bank, well, you know my style, you know it's my favorite bank, so a dividend portfolio is empty if National Bank is not in there. On the losing side, well, I have 4 companies right now, but I mean, let's be honest, Dollarama, TMX Group are barely down, and then Waste Connection is having a hard time. I'm not worried about this one. Highly fragmented market. Taking care of waste, I mean, it's going to be a long-term business. They can grow by acquisition, and they have a solid moat because it's really hard to open a landfill and start offering waste management services. As for CGI, well, they're in a bit of a rut right now. The returns are great. The results are good. Revenue is increasing, earnings increasing. They started to pay a dividend not too long ago. But the problem is a lot of people are concerned about commercial tension with other countries. Maybe CGI will lose some contract. We all know that they work a lot with the government. And then some investors think that AI is going to be a challenge, while management actually think it's going to be a tailwind. So this is yet a story to be developed, but I think it's going to be quite interesting to follow this one over the next few years. So besides National Bank, all the other holdings in my portfolio show a similar profile. Low yield, high dividend growth. So for this month, I'm actually going into the other side of the spectrum where I'm going to pick a high yielder, a stock that pays a yield above 5%. I made a similar play several years ago when I bought Enbridge in 2017. The company was trading with a price weakness because there was a lot of concern around the business. It was also increasing its dividend by 10%, and it was a high yielder. It was a good trade for me. I sold it at the beginning of 2023 for a hefty profit, moved on to another dividend grower, and I was really happy about this play. So ironically, I'm going to do another play in the same industry, so in the energy sector, but this time I'm going to add Canadian natural resources. Let's take a look at the dividend triangle for a second. As you know, I already discussed this one not too long ago in my high yield safe stock video. So you can go back on the channel, and at the same time, do not forget to like this video and subscribe to not miss the next one. Canadian natural resources will go through several cycles because it's highly dependent on the oil price. As you can see, the revenue will go up and go down throughout time. Same thing with earnings, but one thing that is super stable as opposed to a lot of company in the energy sector is the dividend is always increasing. Most importantly, as the oil barrel has not done much over the past 12 months, well, the stock price is a little bit cheaper than usual, so that makes it a very interesting play, both on the yield, but also because the company will continue to have this ability to grow the dividend mid-single digit to high single digit for several years. The key for CNQ is the fact that they're sitting on a very high quality asset with the oil sand. So whenever the oil barrel trades above $35, they're profitable. If it increased further, they can ramp up production and make a lot more money. I like the fact that they're also the second largest natural gas producer in Canada. So they have 27% of their production mix coming from natural gas. The rest is coming from heavy oil, light oil, and also synthetic crude oil, making them the Canada's largest oil producer. I already told you a lot about CNQ in that previous video, but one matter that I wanted to discuss today, and one of the reasons why I decided to add it to this portfolio, was its ability to grow the dividend no matter what happens. What you can see on this graph is the history since 2005. I love when I can go back in time 20 years and see how a company can react to a tough market. Well, in this case, as you know, the oil industry is quite cyclical. Well, between 2005 and 2025, we saw a lot of those cycles happening. One thing is for sure, the dividend kept on increasing. When you look at the payout ratio and the cash payout ratio, most of the time, it is around 50 to 60%, meaning that the company has the ability to continue to grow the business, pay off the debt, buy back shares, and on top of that, pay and increase its dividend every single year. This is something that you will not see very often in the energy sector, and that's the reason why I wanted to add a little bit more to my position. The other thing is, with an oil barrel that trades around 65, 70 bucks, we're still on the low end of the oil barrel potential. I'm not an energy guy. I don't think it's gonna go at 150 bucks a barrel in 2026, but what I can see here is when the oil barrel is weak, well, then it's a good time to get into a little bit more oil. So that's the reason why I added CNQ to my portfolio. I'm going to make the trade in a couple of days right now, and this will also help generate a little bit more dividend down the road to boost my next purchases. So, all right, guys, that's enough for my portfolio. I hope that you have enjoyed this video. Do not forget to give me a thumbs up and like this channel. And until the next video, don't forget to stay invested.